Our topic is residential lending. With me here today is Steve Palombi. Steve has been in the residential lending business for almost 25 years. And Steve is the senior loan professional with Meetinghouse Bank. He is here to share his expertise on residential lending. Welcome, Steve.
Calvin, pleasure. Nice to
Thank you for being here.
Thank you for having me.
Thank you. And so you have a lot of experiences with residential lending. So a general consumer come to you and they want to get a pre-approval letter. And so the first question that you ask, what kind of documentation do you need? So if you can share what are the required documentations that a general consumer need to provide to you so that you can do some due diligence and issue them a pre-approval letter.
Sure. The main thing when you're going to get qualified to be pre-approved for a loan, you're going to need to get together a copy of your most recent pay stub for all applicants. You're going to want to get copies of your last 2 years, which would be 2013 and 14 right now, W-2s and federal tax returns, and a copy of your most recent bank statements and retirement accounts, so that we can take a look. At that point, we'll have all your income and asset documentation required, and at that point, we can pull credit, which is the final step in getting you pre-approved.
So those are the documentations that you need?
That would be the stuff we need up front to go forward, correct.
Okay. And so how long will it take you to check everything before you issue a pre-approval letter?
Once I get the documentation required and pull credit, we can do it within half hour.
Half hour? Wow.
You get it to us.
That fast, huh?
That's fast.
Okay. So make sure that all the documentations are prepared.
As long as you have everything up front, we can go forward and get it done, correct.
Yeah. Okay, great. And so what is the difference between a pre-approval versus a pre-qualification letter?
Okay, a pre-approval is more due diligence done correctly. Mm-hmm. You're pulling credit, mm-hmm. You're getting everyone's documentation together. Mm-hmm. Basically, a pre-qualification, somebody's calling you on the phone. Mm-hmm. They're saying that this is my credit score, mm-hmm. This is my income, this is what I have in the bank, but you're not verifying all the information.
Right.
So you pre-qualifying based on what you're being told. Mm-hmm. To pre-approve somebody, you're going to get all their documentation that we just talked about, pull their credit to make sure it's where it needs to be, mm-hmm. And then that's a pre-approval is official, mm-hmm. A pre-qualification, not so much.
Right. So from a listing agent perspective, the listing agent usually asks for a pre-approval instead of a pre-qualification
letter. Correct. Yeah. Most listing agents don't want to see a pre-qualification
because a pre-approval is more legit.
It is legit. It should be legit. I can't say they all are. Mine are legit. That's what I'll tell you.
Right. Especially with the seller's market, right?
Exactly.
Yeah.
Definitely so.
Yeah. So it is important to get a pre-approval letter instead of a pre-qualification letter.
Right.
Okay. Great. And in terms of closing, what is the average loan take to close? 30 days, 60 days, 45 days?
Basically, if we get everything up front on a loan right now, we're a smaller bank, which is
mm-hmm.
great because we can get things done a lot quicker than most of the larger
mm-hmm.
banks. Mm-hmm. We can turn deals around in 30 days.
Mm-hmm.
30 days or less. I've done deals in 3 weeks.
Wow, okay.
It just depends how everything falls together with the appraisal
mm-hmm.
and everything, getting the documentation that you're requesting.
Mm-hmm. Right.
But we can do them in 30 days. Most deals are 30 days or less.
Now, is this pertaining to conventional loans only or?
Conventional portfolio,
mm-hmm.
Then there are FHA loans, which we'll talk about a little bit later.
Okay.
They take a little bit longer because there's a little more involved, but
mm-hmm. Right.
That still should be within a 45-day period to close those.
So what is portfolio loan?
That's just something each bank has on their own, that it's not being sold on the secondary market, mm-hmm. like the Fannie Mae that you find. Most people have heard of Fannie Mae, Freddie Mac, and so forth, which is mm-hmm. backed by the government. Mm-hmm. These are just ones, the banks that they just keep on their books.
Mm-hmm. I see.
And they might be a little, different, less stringent guidelines to get approved.
Mm-hmm. Yep.
It depends on the situation.
Right. And those loans will be served in-house?
And those are normally, yes, they're served in-house at the bank, correct.
It's not like a conventional loan where, the loans will get sold to Fannie Mae?
Fannie Mae is mostly, yeah. They're usually the backer. It could be sold to any servicer, though, mm-hmm. any of the larger companies that service loans.
Okay. So in this case, let's say if a general consumer were to come to you and they say, I want to get a construction loan. So what is a construction loan versus a 203K loan?
Well, construction loan, I mean, construction loan can involve anything from rehabilitation to a house already that's there.
Right.
It's if you want to put an addition on. It could be somebody that owns a piece of land and wants to just build a brand new house. And anything like that. A 203K loan, that's a rehabilitation loan that's connected with the FHA program, which is you can go in and you buy a property that needs rehab, and they'll fund some of the rehabbing to take care of that.
I see. And how does it work? I mean, for a 203K loan, I mean, do the new owner have to refinance after the loan is closed?
No, the way that they're set up is that like when you go in and apply for a loan, you're going to get a licensed contractor to give you the plans and specs for what's going to be done to the property, what the cost is going to be, and so forth. When the loan is being done, the appraiser will go out and see the property. He'll say, this is the value of the property as is normally, and then he'll say, this with all the work being done, he'll come back. This is going to be the value. When all the work is completed, this is the new value. And basically, if you get an FHA 203K loan or any other kind of type of rehab loan like that, the loan amount you borrow is going to be based on the as completed value, which would be the higher amount.
Right.
And they can lend dependent on that amount.
Which is the future value.
The future value once all the work's completed, correct.
Okay. And how long would it take? I mean, the whole process.
I mean, getting a loan closed on an FHA 203K, it's probably like a 45-day period to close the loan itself, but then the rehab, it gets done afterwards.
Okay.
So
like another 30 days or so?
Right. It depends on the work that has to be done. I mean, they give up, I believe it's up to 60 days right now.
60 days? Okay.
60 to 90 days to get all the work completed.
Right. What if
that
it goes beyond 60 days?
Then they have to make arrangements with the person that's doing the loan for you.
Okay.
And that could change depending on who the lender is and so forth.
Okay. Right. So, and for general consumers who might be able to afford down payment less than 20%. Minimum is 20%, right, without PMI. So anything less than 20% is going to be PMI. What is PMI?
PMI is private mortgage insurance, which is basically it's just insurance that it protects the bank.
Yeah.
Because you're not putting a lot of money down on the property. You don't. I mean, if you're not putting 20%, normally you don't have a lot invested, and it's a lot easier for people. No, not that it will happen, but people can walk away if there's a little blip or something going wrong. It's easier to walk away with less investment. But the PMI protects the bank. You're paying PMI in your monthly payment, but it ensures the bank that if something does happen and you walk away or you get foreclosed on, the bank has protection from the PMI company.
Right. And so would PMI last throughout the loan?
It depends on the loan product. For FHA, currently, as of a year and a half ago, it does last the life of the loan. Like I said, it's a federally backed program, and I think the reasoning was from the government. This is my take on it. This is my
That's
take.
all you can do, right?
I think even my take. That they're doing that because they want people eventually that when they have enough equity in the property to refinance into a more conventional loan, so they're not backing.
I see.
They're backing the loan.
Right. Okay. So that's what PMI would.
That's what PMI does.
Okay.
But there are programs there are certain programs out there like Mass Housing is a state-run government
Like
program.
Soft Second,
It's Soft Second too. You can do it with a lot less than 20% down without paying PMI.
But they have to take classes, don't they?
There are classes, but they're not that bad. A lot of the classes are offered online now. The major portion of it you can do online. They take the class, take tests. And then you have to meet with the council one time. That's it. It's not like the old days where you had to go to 5 classes and so forth.
Right. So for those of you who might be interested in Soft Second loan program.
One program now.
One program, right? Yeah.
Yes,
So and basically they have to take classes. And for nonprofit organizations such as like MAHA, Mass Affordable Housing Alliance in Dorchester, and also ACDC, which is Asian Community Development Alliance or something like that, or association. They located in Chinatown, and also
there's New Westra. There's a lot of different places out there.
Right, that's right.
You can go online, or if you contact me, there's a whole list of different
or you can contact Steve.
Nonprofit agencies that I can give to you and email out to you if you need them.
Great. Yeah. So if you want to look up Steve, just Google Steve and or Meeting Bank, if you will. So or Steve Palombi, right?
Right, Steve Palombi at Meetinghouse Bank.
Okay, you're a superstar, right?
I don't say that.
So people should find you on the website. Okay, so great. That's how you find out classes. You know, if you want to attend classes to get mortgage one. Is that what you call it?
Yeah, the one program is the new. That's the old soft second program. They just changed it over
Okay.
to it's called the one program now.
The one program now.
And then
okay.
plus all mass housing, which obviously has a great program too, which
Right.
you can do like a single family. If you as long as you have decent credit, doesn't really great,
Right,
like a
right.
680 credit score, which is okay, not great, but it's good.
Yeah,
You can
right.
get a single family house with a 3% down payment.
Wow. And the
Without
PMI.
PMI, it's rolled in. They do a lender paid PMI.
I see,
Where the bank
yeah.
will pay a one-time thing.
Okay.
You pay a little bit higher rate than the conventional, but
right.
in total, your monthly payment's a lot less by
Wow.
doing that.
It's a good
It's,
deal.
it's
isn't
a
it?
very good deal.
Yeah,
that's
that's
the way to
right.
go. And a lot of people are doing that.
Right,
They can
I'm
do that.
sure. I'm sure. I would do it if I wanted to pay
When you're ready, I'll take care of it.
We do. So yeah, and now before, well, it's part of the due diligence process at the beginning. What is good faith estimate? If people ask you, say, hey, Steve, can you give me a good faith
Yeah,
estimate?
good faith estimate is just basically breaking down the cost of doing the loan.
Yeah.
It's going to tell you basically what this is the attorney fee, this is the what it's going to cost for the appraisal, this is what it's going to cost for title insurance, all the fees that are associated with the loan, and that they have to within 3 days of applying, it has to be sent to the client, and it breaks down. It's a total breakdown of the fees that should be associated with the loan.
And those fees are subject to change, of
They
course.
can, yeah, I mean, they can. It's an estimate, as it says right in the title.
That's
It's a
right.
good faith
Yeah,
estimate.
yeah, right.
They normally shouldn't change much. I mean, it could be a little change here or there.
Right, right.
And if they do change, I believe now, I don't do those myself, but I think if it's a 10% variance at all,
It's not that bad.
it has to be redisclosed. I mean, you know,
Right.
then you have to redisclose the new fees.
Right.
You can't just all of a sudden go to closing and say, oh, well, it was an estimate. This is the fee.
Right.
It has to be redisclosed once it hits a certain threshold. If it exceeds the threshold, it has to be redisclosed again so the clients know exactly what they're getting.
So is that required for lender to disclose the good faith estimate at the beginning, or?
It's straight. And once you take a loan, you have 3 days. It's a 3-day. They call it a 3 days disclosure. They have
Okay.
three business days to get the good faith estimate out to the client.
Okay. Can they ask for that upfront when they do the pre-approval letter?
Yeah, it's hard because you don't know what they're paying for a property,
Right.
and you don't know what type of loan they're getting at the time.
I see.
I mean, you can give somebody an estimate based on the amount they qualified for,
Right,
saying, I mean, based on this amount, if you bought something for $350,000, you put 5% down, your cost should be in this range.
I see.
But a good faith estimate doesn't go out until you actually have a property
Right.
in mind.
So after you sign a purchase and sale, then
Right.
basically,
Then
okay.
once you have a property, then you can get the more exact figures, and that's when a good,
Okay,
good
right.
faith estimate will be sent out.
Okay, great. And I know that a lot of people keep saying, what is founder commitment? So founder commitment, which means that before the loan get approved by the lender, then the buyer will get a founder commitment. So what is a founder commitment, by the way?
Commitment letters is once excuse me. Once the application, you can take a full application with all the documentation we talked about earlier. It gets submitted along with the purchase and sale agreement. An appraisal's ordered, and once they get all that information comes in into the bank, it goes to an underwriter. They're the ones that make the credit decision. They'll look at all the documentation. If everything works out fine, then they'll issue a commitment letter saying the bank's approving the loan. And this is your commitment that we're going to do the loan. And normally there'll be some conditions depending on what kind of documentation's been received, or if there's any things that, red flags that pop up, that you may need to get some other documentation to back up what you have.
I see.
But a commitment letter basically saying that the loan's been approved and you're good to go. And there may be, like I said, there may be a couple things you just need to clear up or to submit in order to get a final clean commitment. And get it
Is
done.
there such thing called conditional commitment?
That's what they are. Most commitments, there's very few commitments that come out that it's this
Final,
is,
right?
Yeah,
Yeah,
that
right.
takes.
Yeah.
I've been doing this a long time.
Yeah.
Excuse me, and we're pretty good right now. Where I'm working now, the smaller bank, because we try to take pretty complete applications
Yeah,
up front.
right.
And you might get a few conditions here or there.
I see. Yeah, right.
It depends on the bank and how they do it. Very few come out clean, right? That's it. You all set to close. It doesn't happen. It doesn't happen.
Right. If not, it will take time.
No,
right?
and it just
Yeah,
you get a commitment. Normally, if you get all your documentation up front and there's no issues, There might be one or two things that just need to be done.
Yeah.
And then you do those, and then you can get it clear to close, which is
Right.
a clean commitment.
And those could be, minor or major. It depends.
It's usually
on-
I mean, as long as, like I said, if everything's submitted up front that you asked for, and when I get that, I review everything to make sure there's no issues. I mean, if I
Right.
think there's a red flag somewhere, I try to address it before it goes to underwriting,
Right.
so they can, have all the documentation they need to give me as clean as possible commitment.
Right. Okay. So once the final commitment comes out, then basically I would say that maybe 80% of the loan has been approved. Is that right?
Once the commitment's out, you pretty much, when you get a commitment letter, the loan's approved.
Okay.
I mean, once
So
in a
it's
while,
gonna close.
Yeah, most of 99% of the loans that get approved close.
Right. Yeah. And what caused a denial letter? I mean, what caused the bank to issue a denial letter?
It could be there's any number
Like
of factors.
credit issue or
any issue that
employment?
there's guidelines out there for any program. And
Right,
every program
right.
has different guidelines, but
Right.
basically the same.
Right.
You have to have, your credit score has to be at a certain point, depending on the program, to qualify.
Right. Right.
You have to have enough income to qualify. They do qualifying ratios, debt to income. I mean, your debt to income has to be at a certain level to qualify for programs.
Right.
Because if you're not making enough money, obviously, you're not going to be able to pay the mortgage.
Right. Right.
And those are things that will cause that. I mean, if you have bad credit, if you committed fraud on the application, I haven't seen it. I mean, you don't see it
Right,
much,
right.
but people do it. It's happened,
Anything can happen, right?
and that's why the bank does due diligence to make sure everything
Right.
that's been, the loan officer's been told, and all the documentation that's been submitted. They make sure it's all. They verify everything to make sure it's correct.
That's right. Now, especially in this market, what are the most popular residential loan programs out there?
I think right now, I mean, you have like for first-time home buyers mostly. I mean, the one program's great.
Yeah.
We just started at the bank ourselves. We're just picking that up again now. We
Right.
just started. The bank's small. They haven't done it for a while,
Right.
but we're getting that back in within a month or two. We should be offering that also,
Yeah. Good.
which is good. I mean, I've done it since the inception back in '92 at my other place I worked.
Yeah.
We've been doing that a long time. That's a great program. Mass Housing has a great program. Like I said, they have the lender PMI program,
Right.
or the no PMI, where it's a little bit higher rate than the conventional rate, but you get rid of a big monthly PMI payment.
Right. Right.
So it's definitely a good way to go.
Yeah. Conventional.
Conventional is great. I mean, if you have money to put down, I mean, the best way, if you have the 20%, as we said earlier, you have 20% to put down, or if you're going to refinance and you have 20% equity, conventional is the best way to go.
I see. Yeah.
And then there's always FHA. I mean, FHA, which is the federal government-backed program.
Right. Right.
They're a little more lenient on credit and everything else, and so for some people that don't have the best credit, and you can still do it with 3.5% down, it's an option.
Yep.
And the good thing now, they actually just dropped the monthly PMI percent. Just started back at the end of January of 2015. So it's a lot less PMI than it was before.
I see.
So it's good for somebody that is in a position where they don't have great credit, but decent credit,
Right,
and they really
right.
want to get a house, and it's a good starter point to get into
see.
the market.
Right. That's good. Yeah. So before closing, I think within 24 or 40 hours. Now there's a statement called HUD settlement statement. I mean, what is that?
Correct. HUD settlement statement is prepared by the closing attorney for the bank, which is basically it's just a breakdown of the whole transaction. It's it's a 3-page form.
Yeah.
It's going to break down the purchase price. And the first page has two sides. It's going to have the borrower side and the seller side. It's going to break down this purchase price, all the settlement costs, which are broken down further on page 2. And they're breaking, like the good faith estimate, it's basically
Yes.
broken down on page
Right,
2.
right, yeah.
And then it just gives a synopsis on the first page saying, on the left-hand side, we the borrower, this is what you're paying for it, these are your costs. If there's any lender credits or seller credits, they minus it off, and basically at the bottom, it's going to say, this is what you need to bring to closing to close.
Right. Yeah.
And the right-hand side is going to be the seller side, which is basically saying, this is what somebody's buying the house for, this is how much you owe on your current mortgage, and whatever other things might be associated with it, and this is how much you're going to get back after you sell.
So the buyer, with that statement, HUD settlement statement, on the day of the closing, they just gonna go to the bank and get a bank check or cashier check and payable to themselves, and with a figure on the HUD and
Right.
just bring to the closing.
Right. Well, within a couple days before closing, the closing attorney should be contacting the buyer.
Right.
Unless everything's last minute. Sometimes it happens. You know.
It does,
It can
yeah.
happen last minute, but normally in the best scenario
Right,
out there, you know, everything's going to be cleared to close like a few days, like 3 or 4 or 5 days before closing. We're cleared. So the closing attorney for the bank will get all the numbers he needs. He'll do a HUD settlement statement, finalize all the figures, get it approved. Then he'll send it to the buyer or the buyer's attorney so they can review all the numbers beforehand.
Right.
And that way they'll get everyone's happy, everyone's ready to go. They go get the whatever the final numbers they have to bring. Get a bank check, as you said, made payable to yourself, and then you sign it over to the closing attorney.
Right.
At closing.
Right.
To go forward.
So let's go back to the denial letter. Now, I think that a couple of reasons that, other than the reason that you mentioned, for the bank to deny the loan, like for example, like when you verify the credit reports, at the time that you doing the pre-approval, the credits were good. However, towards the middle of the period, then people usually went out and bought something like a car or furniture and stuff like that, right? And
That's
added
enough.
more debt to the credit report, and that's one of the reasons.
That could be a reason.
Yeah,
I
right,
mean, if your numbers are really tight,
right,
if you can be pre-approved, but if your numbers are really, the qualifying ratios are tight,
right,
you cannot go out and do anything else. I mean, you need to hold off,
right,
wait till you close,
right,
then do what you want to do afterwards.
right.
It doesn't happen often, but it has happened.
And don't change job as well,
Don't
right?
change. That's a big thing too. I mean, you can't do it. I mean, once you're in there, I mean, you need to just, it's, like I said, normally a 30-day process, 45-day process.
Right.
You just try to keep tight on everything, stay as is.
Yeah.
If you're going to make a change, let me know up front, or the loan
Yeah.
officer, whoever you're working with
Right.
up front.
Right.
I did have somebody recently that was a nurse who was changing jobs. It was during the period, but that's fine. But I said, give me the letter from the new company saying, I'll be starting here this day. This is my salary. So it continues. So you show
Right.
it's not a change, which you just
That's right.
changing careers or
It has to be continuation.
continuation
Right.
plus in
Yeah.
the same profession. That's a big deal now
Right.
too. You
Right.
can't just change and
And
start.
the pay may not be going down, right? It has to be either the same or go up.
It can't go. I mean, it depends on the city. If
Right.
your numbers look really good when you initially where you're working,
Right.
even if if you had to take, not that you want to take cut and pay, but if you had to take a cut and pay and the numbers still worked,
Right.
but it could be you're taking a cut for a short time so that
Right.
things will get better.
Right.
But as long as the numbers all work still, that's fine.
Okay. Yeah. So those are the most important things. So it's better to be hibernate, right? During the period.
Don't
Slow down.
you slow
With
down.
spending.
Don't
Yeah.
spend any more money.
Yeah.
Don't make any deposits into your
Right.
bank account that aren't your paycheck that you
Right.
can't verify. As you know.
Yeah.
That's
yeah.
that's a biggie.
It's a give, right?
That's a biggie. Yeah. Well, it turns into a gift. But that's a biggie.
Right, right.
That's a big thing you see too. And
That's right.
You need to be able to verify any money that's going to be used in the transaction.
Right.
And
right.
if it's something outside of your normal paycheck, it needs to be documented. And I tell people all the time, I said, you can't do it. But inevitably,
They didn't listen.
some do. Not
Right,
all, but some
yeah,
do.
Right. I think that the best thing is to consult, the mortgage professional before doing anything.
Right. You
Yeah.
just-
That's the best advice, right?
That's the best. I mean,
Right,
like I
that's
said,
right.
I've been wrong many times. Not many times, but I've been doing it a long time. So I think
Yeah.
if you listen,
Yeah. That's right.
99.99% of the time we'll be good.
Well,
That's
that
what-
comes.
that's what I'll leave it.
That's come with part of the teamwork,
Exactly.
So just like everything else, So yeah, and now there are a couple of loan programs out there too. What is jumbo loan?
Jumbo loan, it's just, I mean, like I said, let me start with the conventional loan.
Right.
Conventional loan is basically any loan, like for a single family house, you can go up to $417,000 mortgage. That's a Fannie Mae standard. Fannie Mae set the standards for conventional.
Right.
And then for two family, it's like 542,000. There's certain levels.
Right.
So anything that goes beyond what Fannie Mae's has set for their, the maximum amount for a loan is considered a jumbo loan.
Yep. Okay. Anything beyond those amounts?
Anything beyond what they have is
Okay.
considered a jumbo loan, correct. And right now, I mean, in historically, jumbo loans have always costly, more expensive. I mean, normally you have to put more money down. There's
Right.
none of this 3% down or 5% down. It's normally at least a minimum 10% depending on what you're doing. And historically, the rates have been, higher than conventional rates.
Right.
Now, they're not. Right now, the jumbo loans are a good market right now. That the rates are really they're competitive and they're very similar, if not better, than conventional rates.
Right. So jumbo rate is that going to be balloon up the payment after
No,
5 years?
I mean most of them. No, they don't have that. A lot of the ones that I've done. I do mostly conventional, but I've done them, and most of them you can do 15, 30-year fixed rates, like any other loans.
Okay. So what is the difference between jumbo versus conventional then?
It's just basically the loan amount, the loan size.
The loan size.
That's all. There's the loan size.
it?
That's the basic thing. Correct.
Okay. The loan size and also the interest rates might be a little bit higher.
It used to be high, but right now, right now
because
in
the
this
rates are so
market,
good, right?
they're very, very similar to conventional rates.
Right.
And sometimes they're better.
I see. Now there is also one thing that other than the homeowner insurance, the flood insurance that most buyers would have to pay before closing, and they have to pay title insurance versus their own title insurance. So why do the buyers would have to pay for the lender's title insurance?
That protects the truth. It just protects the lender. The lenders require you to pay for lender's title, which basically is just protecting the lender in case something's wrong with the title. That if there's an issue and something was done wrong in recording past releases of mortgages and so forth, that protects the bank.
Right.
They make you pay for it.
I see. And that's one
I can't
time.
answer that question. It's a one-time thing. That's a
Right.
one-time
Okay.
payment. You have the option to get owner's title insurance.
Right.
You don't need to get that. That's your option.
Oh, okay.
If you're making an investment for that kind of money, I think it's worth it.
Yeah, that's right.
I've only seen it one time where it's blown up on somebody. And they had it where there was an issue.
Yeah, right.
And they actually had. I'll give you a quick story.
Sure.
I had a gentleman. This is probably like 6, 7 years ago. I bought a house in the Boston area. He's been paying on it for say 4 or 5 years. He wanted to do a refinance, so he came back to me at the new company where I am now. And he said, and they did the title, and all of a sudden there was an issue with the way it was foreclosed on. When he bought the house, it was foreclosed on. And there was a ruling back in 2008, 2009 called the Ibanez ruling, where they said there were certain foreclosures that were illegal, and they didn't, even though they were done, they weren't necessarily legal. So this gentleman called me and wanted to refinance. When they did the title again, this fell into that category. So I had to call him back and say, basically, even though you live in the house and you paid for it, you don't legally own it right now.
Oh, wow.
Yeah, that's
scary, isn't it?
That's why you want title insurance.
Oh, wow.
Because now the title insurance company that did it and insured him, and he paid for the owner's title.
Right.
They have to fix it or pay him or whatever, so it's legally his.
I see.
If he didn't have that, he's on his own.
Oh, wow.
And
So that costs a lot of money, actually.
It doesn't. I mean, on a typical loan, it may cost you $1,000 one-time payment up front.
Right, I see.
That's a lot. It's not cheap, but I mean,
Yeah.
If you
worthwhile.
spend a $300,000, $350,000,
worthwhile.
it's worth the money to pay.
That's right, I agree.
And like I said, I've only seen one situation where it came up, but he had it, so it helped him out. And the title company had to pay for anything it cost that it cost to fix the situation.
Well, it's good. Yeah, so it's good to
thing to
know.
have.
Well, Steve, thank you for sharing.
Well, it's a pleasure seeing you again. And
Me too. Thank you.
Hopefully we can do it
so
again soon.
We will. So thank you for sharing. Yeah,
Okay.
and I hope the information that Steve just shared with you is going to be helpful to you, especially when you're planning to own a home first time. So before even look at any properties, it is important to be approved, be pre-approved, and there are a couple of benefits. Now, especially in this market, it's a seller's market, and there will be competitions vying for properties, especially in good towns. And therefore, there are a couple of benefits to be pre-approved. Number one, knowing what type of loan program that you may qualify for. Number two, your down payment, how much you can afford in terms of down payment. 5%, 10%, 15%, 20%, the higher the better, so that you can avoid paying the PMI. And also your estimated monthly payment based on your down payment and the loan amount that you might be qualified for. And also your closing costs, which is the good faith estimate that we just talked about, so that it will help you to budget accordingly. because you don't want to have any surprises during this period before you buy the house and after you bought the house. So you want to budget accordingly. So those are the benefits and other as well. And I leave it up to the loan professional to guide you through of different benefits other than the benefits that I just mentioned. So I hope the information is helpful, and thank you for being part of the show. See you next time.